Hey, this is Skyler with Regan. Today we're going to look at agency mortgage backs and specifically the agency mortgage backed Bloomberg index. So we're going to start quickly with the ag, and I'm going to click on the ag. And I've gone through this before, but you can see the top 6, 7 components of the ag are generally agency 2 and 2.5% coupon bonds. So if you're invested in a total return fund, an aggregate fund, likely these are going to be some of your largest holdings here, the very low coupon mortgage backs. So I'm going to go back and let's just examine the agency aggregate index. So we can see here US MBS. And you can go through a bunch of stuff on here. You have a duration of almost 6, OAS of about 44 basis points, price 88. But what's really important here is, well, what do you actually own? What are you investing in? And is it the stuff that's cheap? You've heard from some talking heads, some large investors out there that agency mortgage backs are extremely cheap. I heard recently that institutional investors, specifically total return investors, are 13% over allocated to agency mortgage backs versus their index, okay, versus corps and treasuries, which are their two other main options. So if you look here, you got Fannie 2s, 2.5s, a couple of higher coupon ones down here, but this one here specifically, you have 7% and 4.9%, a total of 12% allocated just Fannie 2s from 2021 and 2022, or 2020 and 2021. So let's take a look at that market, okay? And some folks might point to current coupon spread, which is the spread at which the current coupon mortgage back, the newer issue paper, is trading over U.S. Treasuries. And we could see here, post-COVID, this is COVID, got up to about 190. Post-COVID was at 60 to 80. Now it's at 143 as of today. That's cheap, right? If we go back much further, it's relatively cheap to this period of free money, really since 2012. It's relatively cheap, but going back a lot further, it's kind of on par with 2000 up through about the GFC. Okay, so we're back to about that level. But let's look at they call it the coupon stack. Okay, so as an investor, you can go out and buy these. These are called TBAs, to be announced certificates. They're generally like futures contracts. They roll every month. And here's a coupon stack. Fannie 2.5s are trading at 82 and 15. It's about $82.50. The current coupon is roughly between Fannie 5.5s and Fannie 6s. Okay, so what I did is I put together a spreadsheet because I wanted to look at, let's just bring in some really relevant data on what exactly you're investing in if you're in an index fund. Okay, and the big agency mortgaged ETFs out there, they are index funds. Their goal is to track the agency mortgage backed index, which is dominated. It's a market weighted index. So you start with Fannie 2s and you go to Fannie 7s. And we saw here's your current coupon. It's the one that's trading closest to par, 5.5s and 6s. But you can see here's your outstanding. So I call these right here index bonds because and this is just Fannie Mae, but that's about 5 trillion. Just in 2s through 3s, you have 3.1 trillion. You have 60% of the market. That's why these are in the index, is because they are the biggest outstanding issuances. But you're not getting that 140, 143 spread that we just looked at. In this issue, you're only getting about 70 spread, okay? You're getting extremely long duration, and you're not even getting a 5% yield, okay? If you go out to what I call the belly coupons, these were bonds that were issued post low interest rates. As rates rose, there was a lot of issuance that came between 3.5s and 5. Today, most issuance is 5.5 to 6. Okay, these two sectors here are growing, but these are kind of like, okay, they were issued over a 18-month time frame, and now they're just not there anymore. Okay. So as you go higher in coupon, you obviously get closer to par, but you're also picking up yield as you decrease interest rate risk. That's really interesting. And I use that right here in this column. Are you getting paid commensurate with the rate risk that you're taking on? So all I do there is I take my yield and I divide it by my duration. And I'm using Bloomberg consensus estimates for prepayment speeds, which are here. Okay. And all I'm doing really is saying, okay, what's the best risk reward based on two very simple metrics? What is my yield? What is my base case yield at current prices divided by my duration? And you could see the higher yield you go, the lower duration you have, the higher coupon you go, the lower duration you get. But you can see here that your yield kind of tapers off slightly. And you're buying this at a $102 price. So if you think rates are going to drop a point or two, maybe you don't want that coupon. Maybe you want this coupon right here where you can buy it at a slight discount and you don't have prepayment risk. But the entire reason we went through this is to think about if you're investing in an index fund that is focused and is benchmarked to the Bloomberg mortgage-backed ag, this is what you own. You own 2s and 2.5s that, frankly speaking, aren't cheap. Okay, you're not getting 144 spread. You're only getting roughly a 65 to 70 spread. Okay. And one other piece of information we put together, which is going back 10 years, if we look at floating rate paper, so this is fixed rate paper here, current spread's 143. Mean spread over the last 10 years is 105. It's trading slightly wide of that. Okay. It's at its 86th percentile. So it's at a really nice percentile, but nominally speaking, it's only, 40 basis points wide of what it is traditionally. If we look at agency mortgage-backed floaters, okay, here's your floating rate spread chart over here. These got to as low as about a 15 or 20 spread. They're trading at 2.4 standard deviations from the mean, 95th percentile. So agency floaters you can actually buy really, really cheap. I think fixed rate paper is cheap as well. You just have to focus on the right part of the curve, the right risk reward. But if you're going out and buying a total return or an index fund, you're probably not in that cheap asset like you think you might be. Thanks.